This video will cover Chapter 3, Financial Statements and Cash Flow. Notice I've scratched out taxes because we're not going to cover them. They're covered in personal finance and they're also covered in accounting courses. An outline for this video is as follows. We're going to review financial statements. We're going to look at the balance sheet, income statement, statement of stockholders' equity, and statement of cash flows for a company called Chippy. It manufactures snacks. And using those financial statements, we're going to estimate free cash flow, economic value added, and market value added, and do some financial statement analysis. Let's do an overview of Chippy Inc. Chippy Inc. is a snack food company that underwent a major expansion in year one. And so far, the results have not been good. The company's cash is dwindling, suppliers are being paid late, and the bank has threatened to cut off credit. The board of directors has ordered some changes that must be made. And so what we're going to do is try to dissect what happened, figure out what the possible problems are, and see what we can do about them. Now, before we go any further, it's important when you look at financial statements that you also look at the story that goes behind them. Financial statements have a story. If you just look at the statements by themselves, the balance sheet, income statement, statement of cash flows, you're going to get some part of that story, but it won't be complete. You need to read the president or the chairman's or management's message, which goes to shareholders. It's usually at the beginning of a set of financial statements. That helps fill in many of the gaps. And not only that, but you can compare what the president or chairman is saying and then what the financial statements are saying and see if they line up. They should line up. But in any case, just looking purely at financial statements, it doesn't really give you a complete picture. You need a little bit of background, a little bit of messaging that goes with it. Okay, so now let's take a look at the balance sheet for year one and year two. So now let me pause for a second on something that's rather trivial, but look at the heading. It says as of December 31st, at a point in time. Remember, balance sheets are a snapshot at a point in time. Now let's continue with the analysis. Look right here. And right off the bat, see, you can see that cash has dwindled down. And this is in, you can think of this as in millions, but we're going to chop off all the zeros. So it went from 57 million down to 7 million for cash. And look what else happened. Accounts receivable jumped tremendously. Now that's like, well, why are your customers not paying you back so quickly? Why is that going up? Well, that's a good question. We'll see. That can also account for the low cash balance. If your customers are slow in paying you, well, you're not going to have much money in the cash register, so to speak. You're going to have a fistful of IOUs, which are what accounts receivable represent. So, okay, so that's kind of making sense. Well, then we look below a little further. We see inventories have jumped up tremendously, which is a signal that the company is, stocked up a lot of inventory, built up a lot of inventory, and it has not been sold. That's another explanation for the low cash. It takes money to buy or make inventory. And so we see current assets have jumped up tremendously. And then fixed assets. Now this is interesting. If you look at fixed assets, they've jumped up tremendously also. And that's a signal that management's buying machinery, equipment, property, plant, and equipment with the expectation of high future demand for their product. So you generally don't increase property, plant, equipment if you think things are going to stagnate or go down. And so here we're starting to see that, okay, the management sees high expectations. They're looking for expansion. Their accounts receivable and inventories have shot up as a result of it. We should, in a few minutes, see a jump in sales. So that should cross your mind. So what the sales look like? Well, we'll get there in a second when we look at the income statement. Let's go down the line here. Depreciation has jumped. Well, of course it has, because fixed assets have jumped. And then you can see total assets have about doubled. Let's look at the liabilities and equity section. Well, we see a tremendous increase in accounts payable. Now that actually adds cash to the company because with accounts payable, the company is delayed paying its suppliers. And that's jumped up tremendously. So, if you look at the inventory that shot up on the asset side, then you can say, oh, they have some accounts payable that's associated with that inventory that's building up. Then you see accruals going up. That's usually, for example, salaries that have not yet been paid to workers. And then we see, okay, notes payable. So notes payable have shot up. Those are bank loans, and that shot up tremendously. So, we saw on the asset side, cash has dropped tremendously. We can see inventories up, accounts receivable up, and that used cash. But look at the gains in cash, so to speak, with accounts payable. So if you had no accounts payable, you'd have to pay, in this case, $524,000 to get rid of your accounts payable. The company doesn't have $524,000 in cash to do that. And it doesn't have the cash to pay its workers if those accruals are salaries payable. And it won't have the money to pay off the notes payable. So those current liabilities are funding some of those current assets. That's obvious. Now look at long-term debt. That's jumped up tremendously. That's actually good in my mind to see the long-term debt go up because the fixed assets went up. And you generally don't want to fund fixed assets with short-term or current liabilities. You want to fund long-term fixed assets with long-term debt. Typically, that's how you want to do it. Common stock is unchanged. Retained earnings have dropped. Either they paid a big dividend or they're losing money, which means a hit on retained earnings, meaning a reduction in retained earnings. So let's go further. Here's the income statement. Now, before we go further, let's pause a second and make sure we know that an income statement covers a period of time. It's sort of like when you do your taxes. You basically fill out an income statement for the IRS. It covers an entire year or a quarter. So now let's see if some of our expectations we talked about a few minutes ago pan out in the income statement. Okay, so look, we see a big jump in sales, which is good. So the company has experienced higher demand, and so that's materialized in its sales. The cost of goods sold have jumped up. Now, you could do some analysis to see whether or not sales and cost of goods sold have jumped up equally in an equal proportion to each other. And if you do that analysis, you'll find out the cost of goods sold had increased about 93%, where sales have only increased about 78%. It's not too far off, but still, it's going the wrong way. Sales have increased, but cost of goods sold have increased even more on a percentage basis. You might speculate with a 78% increase in sales that they're probably paying overtime to workers, and that could account for the extra jump in the cost of goods sold. Other expenses have shot up, not unexpected given what we've seen so far. Then we see depreciation and amortization. That's gone up. We know that would be the case given that they have more fixed assets. And then EBIT, earnings before interest and taxes. So this is a term that you're going to see a lot of, EBIT. And EBIT represents earnings before you deduct interest expense and before you deduct taxes. And so that's often a measure of operating income. It's often assumed in accounting that interest and taxes do not represent operations. And so that's often a measure of operating income. And here, look at it, it's negative now. It was 190 million here in year one. Now it's negative 38 million. That's a hard hit. Interest expense has gone up, which makes sense because notes payable have gone up, long-term debt has gone up. So that's all consistent so far. Then earnings before taxes down negative 160. That's where we're seeing that drop in retained earnings coming here on the balance sheet. See this drop in retained earnings? That had to have come from the net loss that we're seeing, negative net income. Other data here is the number of shares, earnings per share, dividends per share, stock price. Look at the stock price has dropped significantly. That kind of tells you that shareholders don't foresee, because remember, stock prices are forward-looking. They don't foresee good things happening to this company. So remember in the notes that we looked at right before we looked into the balance sheet and income statement, we saw that management is in the middle of a big expansion. Well, sure, they are expanding. In fact, they're expanding maybe too fast, but stockholders don't seem to have much confidence in what's going on. Lease payments, probably for rent, say for building space and for holding inventory in warehouses, has stayed steady. Now, let's reconcile stockholders' equity. And so it's important you be able to reconcile stockholders' equity. It makes sense. I would focus here on the retained earnings component. So we started out with $204 million in retained earnings, lost $160 million, and then paid $11 million in dividends, and then had a balance of about $33 million. Now that cash dividend, to me, is in jeopardy. It's in jeopardy for two reasons. One, the company doesn't have the cash to pay it in the future. And two, the company's retained earnings are dwindling down to nothing. It's going to be hard to explain to shareholders that your retained earnings went negative because you paid a dividend. It just doesn't look good. Now, let me cover the statement of cash flows, and it's all laid out nicely here. What I'm going to do in a minute is I'm going to recreate the statement of cash flows and discuss how each line is computed and interpret each line. Because I could just throw up these statements here with PowerPoints and just fan right through them, but you really won't get the intuition. So the intuition comes about by me pulling apart the financial statements and assembling it in the statement of cash flows. So here we see the net income, which is negative. We see depreciation and amortization, which is an expense that doesn't take cash. So that $116 million, $117 million gets added back. And we see increases in accounts payable, which is good because that adds cash flow. Increase in accruals, that adds cash flow. An increase in accounts receivable takes away from cash. It's basically your customers gave you IOUs instead of cash. Well, of course, your cash balances are going to be hurting. Then we also have an increase in inventories, and that had to use cash. So net cash provided by operating activities, and that's really important in the world of finance from stockholders and investors. They want to know what your operations are doing because that's the bread and butter of the company. If your operations aren't doing well, your business is not doing well. It's that simple. Now, there's two other components to cash flow besides operating activities. One is investing, and that here is primarily changes to property, plant, and equipment. And we know that was a big number, a big increase. So that drained the cash, $711 million. And then we have financing activities, the notes payable from the bank, which increased $437 million. Well, that's positive cash flow. In the increase in long-term debt, the company floated $400 million in debt, and so that added cash flow. The payment of dividends was a drain of $11 million. So now, the whole point of this statement of cash flows, this is where it all boils down to a summary of what happened. The cash flow for the year dropped $50 million. You see this number right here? It dropped $50 million, and that $50 million is right here. You see that? This dropped $50 million cash balance. And that's what the statement of cash flows reconciles. So it's saying, look, here's cash dropping $50 million. Cash at the beginning of the year was $57.6 million. And at the end of the year, it was $7 million. And what you're seeing here is this net decrease in cash is the sum of this minus 164, the 712, and the 826, all net to a negative 50, which is 50 million. And so there you have it. You can always check your work with a statement of cash flows because you're reconciling that cash balance. If you got everything right, it all boils down in this summary and adds up, so to speak. So as I said a few minutes ago, I'm going to cover the statement of cash flows line by line. If you're happy with what I just presented, a cursory review of it, skip this section. But if you're interested in a little more interpretation, keep listening. So we're going to look at the statement of cash flows. Statement of cash flows. And the first thing is operating activities. It's the first thing that pops up. As I said a minute ago, it's the most important part of a company. If your operations aren't working and they're not providing cash flow, analysts are going to be looking at it carefully. What do I mean by analysts? Well, stock analysts, for example, and even people who work in the company. They're going to want to know, are we generating cash? Because if your operations aren't generating cash, you're going to have to rely on external financing. You're going to have to borrow money, issue stock, or something to that effect. You want the company to have positive operating cash flow in the long run. Now, there could be periods in which it goes negative, which is fine as long as it's temporary and you can account for it and explain it. But in the long run, it's got to be positive. So the first thing we do here is in this statement is we take net income. And net income was actually negative. It was a loss. And what we assume is that the net income off the income statement here, we assume, so here's the income statement. We assume that this net income number is cash flow. And then we adjust it for things like, right here, depreciation and amortization, which we know is not a cash flow. Because remember, when companies buy fixed assets, they put them on the balance sheet and they slowly depreciate them over time. And the depreciation is not the cash flow itself. It's the actual purchase and acquisition of the equipment, which in some cases happened many years ago. So we have negative 160 million, and then we have depreciation and amortization, and that is 116,960,000, and that's going to add to the cash flow. And now we have to account for changes that happen on the balance sheet here that's not reflected in the income statement. And those are the changes in accounts receivable, changes in inventory. Because notice, accounts receivable went up just like I said a few minutes ago. That had to have drained cash because it effectively drained cash. Yeah, that's right. So let me clarify that statement a bit. When we looked at net income and we took net income, which happened to be a loss of 160, we assumed that the sales, the top line of the income statement, generated all cash. But you know that those sales did not generate all cash. A lot of people handed this business IOUs. If that's the case, the sales aren't all cash. They're IOUs. You need to adjust that sales amount, which ultimately affects the net income that we just put down of negative $160 million. So let's take that into consideration. And then if you spent money on inventory, well, obviously you spent money on inventory. It had to drain your cash in order to get this inventory. So let me interrupt this video for a second and give you a little more intuition by what I mean by this inventory changes. Essentially what I just did and showed you was I showed you that there's a difference between the beginning balance of inventory and the ending balance. So the beginning balance was the ending balance of year one, and then we have the ending balance of year two. And in between you have purchases which use cash, and we have cost of goods sold here. So this cost of goods sold shows up on the income statement. We're assuming that's all cash. In other words, the value of the inventory that went out the door in our sales was a cash use because it was an expense. But how do you account for the purchases of inventory? Well, we could net cost of goods sold and purchases, but we generally don't have purchases available. So how do you get to the net of these two? Well, you just take the net of the beginning balance and the ending balance. And that's exactly what we did on the balance sheet. And so therefore, we got the net effect of the change in inventory on cash flows. So now let me get back to the story that I'm telling about this statement of cash flows. So what we have to do is look at and reconcile these changes. And these things are considered part of operations. I mean, think about it. Your business is involved in buying and selling things and producing things. Then accounts receivable and inventories are part of your operations. So now let's look at accounts payable. And so we have a big increase in accounts payable, which represents an increase in cash flow that's not accounted for in the income statement. And let me give you a little sidebar on that, and so we can reconcile it. So if we have accounts payable, we have a beginning balance. We're going to have borrowings from the bank, and we're going to, I'll just call it payback, amounts we pay back of the borrowing. So this is going to be positive cash flow. We're going to pay back, and then we're going to have an ending balance on our notes payable. So what we're doing is we're just looking at these two differences, and the difference between these two amounts has to equal the difference between these two amounts, and it works. So if this was 100 and we borrowed 400 and we paid back 200, well, that's 500 minus 200, that's 300 is our ending balance. Look, that change is $200, which is an increase, and that is the same as this $200 difference. And so we can just pick up these two differences, and we're implicitly backing into these numbers. Now let's get back to the story again. So there's going to be an increase in accounts payable. And that increase turned out to be $378,560. There was an increase in accruals. And as I said to you before, these accruals, you just imagine that they're salary expense. So let's say, the cutoff for the income statement is December 31st. Well, there could be a week in which employees earned salary, but they weren't paid because they're paid monthly or they're paid every 2 weeks, and they won't be paid until the next year. In which case you have to set up an accrual for that expense, and that accrual increased by $353,600,000. So that amount showed up on the income statement as an expense, which we assumed was a reduction in cash flow, but it really did not represent cash flow, so we need to make an adjustment for that accrual. Or more precisely, the increase in the accrual. And then we have to look at the increase in accounts receivable. And as I said before, if accounts receivable go up, it means implicitly you haven't gotten the cash. So it has a negative impact on cash flow. And then you have an increase in inventory. And obviously, if your inventory is building up, it costs money to build that inventory up. And we have a huge number here of $572 million increase, which drains cash flow. And so net cash provided by operations or operating activities is 164,176 negative. So you should be looking at that really carefully. That's not a good sign under most conditions. Now remember, this business is the snack business, snack foods, and they're going through a massive expansion. Well, if you're going through a massive expansion, well, you're probably building up your inventory, you're building up your business. It could be temporarily that you have negative cash flow. That would be plausible and that would be plausible and acceptable to a lot of people, provided they start seeing positive cash flow in the future, which would mean that this number would become positive and much bigger. And then you would, if you were to slow down in growth, then your accruals would level off, your accounts payable, your accounts receivable, all the growth here would start to level off, and you'd have positive cash flow. And there you are, you're on the right trajectory at that point. So now, if operations drained $164 million from the business, where did that come from? And that's where the other parts of the statement of cash flow come into play. And so I can just draw a line here and say, look, we have investing activities. And so as I said before, if you're investing in property, plant, and equipment, it's an acquisition that goes on your books. It gets capitalized as an asset. But somehow we have to account for those cash flow effects. But it's not being accounted for on the income statement. So we have to reconcile that in the statement of cash flows. It's affecting cash, but when you buy an asset and it gets capitalized, it doesn't affect the income statement. So what we have here now is that increase in property, plant, and equipment comes right off of the balance sheet here. So your change in gross fixed assets is about $712 million. And that's basically the purchase of fixed assets. Technically, net purchases of fixed assets. So there's purchases of fixed assets which reduce cash, and then there's probably a little bit of sales of fixed assets along the way that should be netted. Those sales represent positive cash flow. So you net the purchases minus a little bit of sales of maybe they sold a car, maybe they sold a piece of equipment, in which case you want to get the net effect. And that's what we're capturing here. Moving right along, gross means it's before accumulated depreciation. This is slightly misrepresented, is it's not depreciation expense for the period, it's accumulated depreciation. So then you subtract accumulated depreciation, you get that net fixed assets. So property, plant, and equipment went up $712 million. That drained cash. And that's the only other investing activity this business has. Normally, businesses have investment activities such as buying stocks and bonds and other assets, in which case that would be included in this section. And so if you're growing, you tend to be investing. And so this tends to be negative, and that's not a bad thing. So generally, you want this to be positive, investing to be negative to show that you're growing because you're investing in the future. And then you have the financing activities, which balances the whole thing. So you don't really need financing activities. If your operations are generating positive cash flow and then you're investing that positive cash flow and these two net out, then you don't need any financing. But most businesses will need some type of financing because there's ups and downs and fluctuations in the business and the business cycle. Businesses have to borrow short term, especially if their business is seasonal, and they borrow long term, and sometimes they issue stock, and often they'll pay dividends, which is going to be reflected in this account. But ignoring dividends, if your cash flow is positive from operations and it actually offsets your investing, you don't really need any changes in financing to get this to balance out. So let's take a look at here. We have an increase in notes payable, and those notes payable increased $436 million, and that's positive cash flow coming in from the bank. And then we had an increase in long-term debt. That was $400,000 in bonds issued. That's positive cash flow. And then we paid dividends of $11 million. And that's going to be a negative. And dividends are not an expense on the income statement, which is why it's showing up here. So the total financing ends up to be $825,808. And so if we reconcile cash flow here, now remember, reconcile cash balances here, then this difference is a loss or a drop of $50 million. So we have a net decrease in cash balances of $50,318, and that's negative because it's a drop. And then we have cash beginning balance. Beginning of the year is $57,600,000, and at the end of the year, cash was $7,282, and then the whole net effect is $53,118. Oops, this amount. So it reconciles piece by piece. Now, keep in mind why I just spent some time on this statement of cash flows. Remember what I told you in previous videos, and it has to do with all of finance. The value of any asset is the present value of its future cash flows. It's a function. Right now, think of it as a function of your future cash flows. So my point is, you got to be able to calculate cash flows to be able to value a business. So now what I want to do is I want to look at some valuation metrics, some measures of valuation, like economic value added and market value added, and then ask a series of questions about the profitability and the operations of the business so we get a better understanding of what happened and we can knit together a story. So now let's look at performance measures so we can evaluate managers. Are they adding value to the firm? There's two ways to look at it. One is market value added, and the other way is economic value added. Market value added is a snapshot at a point in time, just like your balance sheet. So the data that we're going to use to compute this is going to come off the balance sheet, at least some of it. And then this term here, economic value added, covers a period of time, like a year, for example. And so some of the data here will come off the income statement. So the market value added concept is this. We're going to take the price at a point in time, times 0, multiply it by the number of shares outstanding, and that's called the capitalization of the firm. It's an important term in finance because this is the market value of the firm right now as of time 0. And so you want capitalization to be large for a company because it has a lot of shares, it has a good price, it's a very valuable company in terms of the stock. And we want to subtract off of this book value. Book value is the accounting estimate for equity. It comes right off the balance sheet. So let me plug in the numbers here. This, if you recall, comes from the data sheet here. So you could have the data sheet. We got a stock price of $225 and $8.50 as of year one. And then in year two and year one, the number of shares have stayed the same at 100,000. So the price is $225 times the number of shares, 100,000. So the capitalization of this firm, and everything's in thousands, so this is actually $225 million. So it's $225 million because these shares are really 100 million shares. And so that's the capitalization. And if you look at the balance sheet now, and I'll show you in a second here. If you look at the balance sheet, here we got the balance sheet. And we have the book value for equity in year two, and in year one, here it is. And so let's do this. We're doing this at the end of year two at this point. And this is 592, and this number is 267,592. It really should be called MVS. MVS for market value subtracted. Nobody calls it that term, but when this thing comes out negative, it kind of doesn't make any sense. Other than, man, things aren't going well for this firm. Because look, this is an old book value. You should have a market cap well above this number here. And it's actually below, and this number is negative. So it's like market value subtracted or detracted in this case. And so that's obviously not good. The managers of this company are not adding value to shareholders. If you were to recalculate this as of year one, this number would have been 850 times 100,000 or 100 million, and minus the book value of 663,768. This comes out to be 186,232. It's positive, which makes sense. The managers in year one were adding value to the firm because people invested this book value. And this is what it's worth now. You want this to be as big as possible. And it's 186. So the company obviously is not doing well in year two. And you should look at it from a little more conceptual perspective here. We're looking at a stock price at time zero. And stock prices, as we'll find out later in this course, and this is an important concept, stock values are forward-looking. People buy stocks based on what they expect to happen to future cash flows. You don't want to look backwards when you buy a stock. You want to look forward when you buy a stock, because stock prices reflect what's going to happen in the future. But then you have this book value number, which is the past, essentially. It doesn't quite conceptually make sense. So in my mind, this is not a very useful tool, because if this book value is not up to date and not recent, meaning the amount of equity that was being contributed to the firm, then this whole number falls apart and there's not much value. If this book value is very recent, then yeah, this will make sense for sure. There's lots of other metrics to use to evaluate managers, and we'll talk about that later on in this course. So that's market value added. Now let's look at economic value added. In fact, I'll get a new sheet here. EVA. And EVA is EBIT times 1 minus T minus the total invested capital of the firm, and this is the total debt and equity that's been contributed. That's how much people have invested in this business because they invested in the company's bonds and they invested in the company's stock. And we multiply this by the cost of capital. The cost of capital. This is in a percent, in decimal form. It's basically a percent. This is a dollar amount, and this is dollar amount. So economic value added is a dollar amount. So let's make sure we got the right units here. And so The cost of capital, sometimes called the weighted average cost of capital, we have a whole chapter on this towards the end of the course. And it's basically a percent. It's like, it's a weighted average of how much does it cost you to borrow money, like bonds, which is the yield on a bond, and then how much does it cost to issue stock. And so those two things have a cost, and so you average the costs. So if your bonds have a cost of 10% and your stocks have a cost of 14%, then, and if you're 50-50 weighted, then you have a 12% cost to capital. And so don't worry about this calculation. I'm just going to use a 12% cost to capital. So if you want to start up a company, contribute some debt, contribute some equity, it's going to cost this firm 12% to get that money. That's the opportunity cost of money. Okay? Like I said, we have a whole chapter on it, so don't worry about it. This is just a given at this point in time. Just throw this number at you. 12% could be 10%, could be another number. Okay, invested capital now comes right off the balance sheet. So invested capital is going to be long-term debt and total equity here. And if we look at it, this is going to be 723, 432, and 492, 592 for a total of it should be 1,216,024. And so you multiply that by 0.12, and this right here, this component right here, is going to be 145,923,000. That's the cost of capital. To raise capital, you got to pay that off to bondholders and stockholders effectively. And what you want to do is you want to earn, this is earnings before interest and taxes from your operations, excluding taxes, so it's after tax, enough money not only to pay off your stock and bondholders, but to make even more if you could in a particular year. And so now you have your earnings before interest and taxes, 1 minus T. And you got to beat this 145, this 146 million, the 146 million here. Okay? So if we plug this in, by the way, if we pull these numbers off of Chippy's income statement, these numbers are negative. And so because the company lost so much money. So when you have negative EBIT, this formula doesn't really make sense because it's not designed to look at a firm that has losses. Because obviously you don't have to do any calculations to know it's not adding value if the company's losing money. It's really economic value subtracted again or detracted. And so it's a calculation, it's a valuation method, it's often used, but it doesn't apply to this firm because of the fact that it's negative. Now, one other thing here with this EBIT story is, this is a bit confusing in your book. This is often called NOPAT in your book, net operating profit after taxes. That's what this whole term is right here. And it's often called after-tax operating profit. Okay? After-tax operating profits. They all mean the same thing, but it can be very confusing because it all sounds alike. But keep in mind, these three things mean the same thing. Now, this is, take a look at what's going on here. This is operating, right? So it's after-tax operating profit. So it's earnings before interest and taxes, but then we subtract out the tax effect. So 1 minus T is the tax effect, and we're looking at after-tax operating. Why is it operating? Because we're looking at the earnings before interest expense, expense and interest in the borrowing of money. That's a financing aspect, as we saw before. It's not an operating component, so that's why it's before interest. And then we pull the number off the income statement before taxes, but then we subtract out taxes. So technically, the whole thing is on an after-tax basis. It's a little confusing, but that's just the way the world works. EBIT is a very, very, very common tool in the world of finance and accounting. And it's often a separate line item on the income statement, so it's easy to pull off the income statement. So now, with this in mind, let's look at net operating working capital, and we'll use that to help determine the free cash flow of the business. We really want to look at free cash flow. That's a really important concept. It pops up a lot on the quizzes, and it's used in both this course, in a basic corporate finance course, like we're looking at here, basic financial management. It's often used in investment management also. So it's important you get that understanding of what free cash flow represents. It's a measure of cash flow. So let's start off now with looking at net operating working capital. Now, in order to estimate free cash flow, we need to first estimate net operating working capital. Net operating working capital is defined as this. It's current assets minus excess cash. And excess cash is cash that some companies have well in excess what they need to work on their operations, to continue operations. They have way more cash. That's what we mean by excess cash. It's a judgment call. And in the example we're looking at with Chippy, there is no excess cash. Cash is pretty minimal, so we don't have to worry about that. That'll be zero. Now, some businesses hold billions of dollars of excess cash. Apple is a good example. It holds billions of dollars of excess cash, and some people consider it to be a war chest in a sense that it can do a big acquisition if one ever comes about. And some people look at it as a drag on the operations of the business. Why don't they just give that back to shareholders and let the company operate on a more efficient manner without holding so much cash? Yeah, so there's pluses and minuses to holding excess cash. So we have this current assets minus excess cash minus current liabilities minus notes payable. So notes payable are included in current liabilities, but notes payable are not part of operations. Remember, they're part of financing. So people don't consider a bank loan to be part of operations. So this is how net operating working capital is calculated. Now, I like to think of this concept of net working capital. And so conceptually, it's kind of like this. Here you have a balance sheet, and here you have your current assets, which is cash, accounts receivable, and inventory as you being your primary categories. And that's your current assets. On your liability side, you have, accruals, you have accounts payable, and you have notes payable, and that's your current liabilities. And then on your asset side here, you have long-term assets. I'll just call it long-term assets, like fixed assets, property, plant, equipment, and so on. And here you have long-term debt, and you have equity, which are long-term financing used to finance this side of the balance sheet. So think of operating capital as this. Net operating working capital is this, minus this notes payable, because technically a notes payable, even though it's a current liability, is non-operating. And then we have to check, is the company holding too much cash, excess cash, beyond what it needs for operations? Because look, companies need a cash balance to operate. You just need some cash to be able to pay your bills and to finance business. You're going to need accounts receivable because your customers are not going to be able to pay you immediately. And then you're going to have inventory, and inventory is part of your operations. You can't really deal with business on a day-to-day basis without inventory. Now, I say that there are, by the way, just-in-time inventory processes where, and for example, Toyota is one of them. And that's where they manufacture a car and they bring in all of the inventory right then and there the same day. So there's no holding of inventory. Notice that this cash, accounts receivable, and inventory, this is money tied up in the business to do operations. If it could have just-in-time inventory, it could get rid of most of its inventory balances. In a sense, that just-in-time inventory concept is saying, look, if you're holding inventory, you're kind of inefficient. If you could run things more efficiently, you really don't need much inventory. That's for a manufacturer. Now, retailer is a different story. You're going to need to hold some inventory to make it look like you have your shelves full. And then accounts receivable, well, that's part of operations, but it's a little tougher to control because it depends on your customers. And then if you're really savvy with your cash balances, you don't really need cash. If you're really savvy with your payments and how you manage your cash, you don't need that much cash on hand. So the cash on hand represents an opportunity cost because it's not invested somewhere. And the same thing here. I mean, this is invested in operations, but if you could be really efficient and reduce your footprint here, that means you have more money in cash flow to buy property, plant, and equipment, things like that. So this is the concept of net operating working capital. This side is thought to be used to fund and finance this side. So that's why we're taking this minus this component. So let's actually estimate it. So if we look at current assets from the balance sheet, it's 1,926,802. We're going to assume there's zero excess cash. Probably a good assumption because it's only 7 million and change at this point, not much. And then we're going to subtract off current liabilities and subtract from that notes payable. And we end up with net operating working capital. In year 2, I'm going to say X2. In year 2, it's going to be 913,042. And if you did the same calculation in X1, you would end up with 1,124,000, and this would equal 842,400. The difference is really what we want to get at here for free cash flow. So keep in mind we had 842 million tied up in working capital, operating working capital on a net basis once you subtracted out the financing from current liabilities. And then it went from 842 to 913. So we just kind of build up a whole bunch of working capital, which takes a lot of resources to do. And so that is the change in net operating working capital. Change in net operating working capital. It's important because a lot of people, they just calculate the net operating working capital, but it's got to be the change. And the change here is going to be 7642 increase, which is, it's consistent with the fact that this business is trying to ramp up and expand, but it's also consistent with a story that it's maybe utilizing more working capital than it needs, and it could be run a little more efficiently. And another way to interpret that is it just took 70,642,000 of cash flow to build that working capital up. So that's a use of cash. So now with this in mind, let's move over and calculate free cash flow, because this component right here is a part of free cash flow. Free cash flow. Free cash flow is defined as how much cash can be withdrawn or siphoned off the business so that the business can continue its current operations and future operations without being impaired. And that's why it's called free cash flow. It's kind of like excess cash flow that the business has that you can periodically siphon off the company. And so free cash flow is estimated over a period of time, for example, a year. The definition of free cash flow is your EBIT after tax. That's your NOPAT, which is net operating profit after tax, which is also called after-tax operating profit, as we discussed earlier. And then you have depreciation, which is a non-cash flow expense that we need to add back. And then what we need to subtract out of this is CapEx, capital expenditures. This is an important component for security analysts. Security analysts often want to know, how much did you spend on capital items such as property, plant, and equipment? So CapEx measures how optimistic the management of the firm is. So if you have a big ramp up in CapEx in 1 year, security analysts like that usually because it means that management expects strong demand in the future and you need to ramp up for it. So keep in mind that security analysts are, for example, stock analysts, and they put out buy, hold, or sell ratings on a stock. And if you see an increase in CapEx, it's an important part of the story as to whether or not the security analyst, the stock analyst, is going to be optimistic about the future of this company and a growing stock price. So CapEx is here, and then we also have plus the change in net operating working capital that we just worked out a few minutes ago. So this is your operating cash flow, basically, right here, these two components. And then you have to subtract off your change in fixed assets, which is CapEx. And this is calculated and subtracted out of here. This is included in here because, look, in order to keep the business running in the future, you have to invest in it currently. And then the question is, well, how much working capital are you building up also? And so that gets deducted because if you need more working capital, that siphons off cash flow. That reduces the cash flow that's available to stockholders because it's getting tied up in inventory and accounts receivable and cash balances. So this is for a particular year. This comes off the income statement for a particular year. This is depreciation for a year. This is the change in fixed assets for a year. And this is your change in net operating working capital for a year. Now, the biggest mistake people make with this is they forget to change. And that would, if you forget to change and you just use net operating working capital, you should stop right there and say, well, does that make sense? Because this is free cash flow for a year. This is your earnings for a year after tax. This is your depreciation for a year. This is your investment in fixed assets for a year and property, plant, equipment. And this, if you don't have this little delta here, you just use net operating working capital. This is at a point in time off your balance sheet. That doesn't make sense. You got to have the change because then it's a flow over a period of time. So if we estimate this, this will be minus 38. This component right here is your fixed assets, your gross fixed assets minus fixed assets earlier from the previous periods. And we just calculated this as being the change in net operating working capital, 70 million. This whole thing boils down to 694, 246 negative. Obviously, if your free cash flow is negative, that's not good. Usually, it means it's not good. If you're ramping up your business and this CapEx is tremendous because you have bright prospects for the future, it's okay that your free cash flow is negative. But in terms of this business, Chippy, it's not so easy to interpret. We know the company is ramping up for future demand, and so that's why you see CapEx going up, but it's not executing very well, and at the moment, earnings before interest and taxes it's negative. So that's the bad part here. So, the whole story boils down to, can this company start earning a profit in the future? So this business is bleeding cash flow, and it naturally leads to the question, can it pay its suppliers on time? Let's take a look at that. Accounts payable has gone up 260%. 260% increase in accounts payable, while sales have gone up about 79%. And so there's a big disparity here. You would think that if sales went up about 79%, accounts payable would go up, approximately the same amount, but it hasn't. Accounts payable has gone up dramatically, which leads us to believe that maybe this company, Chippy, is not paying its suppliers on time. And in fact, the suppliers may cut credit if it continues. So that's a little concerning. Now, the next question becomes, well, maybe they can increase their sales here. Maybe they can boost that sales, get the cash flow, and get out of these problems. Well, let's think about that. Right now, the company has 30-day credit for its customers. Keep in mind, I didn't give you this information about the 30-day credit previously, but I'm giving it to you now. What if it boosted that up to 60 days credit, 60-day credit to increase sales? So if you increase the amount of time that your customers have to pay their bill, then you're probably going to increase sales. You're going to attract more customers. But the problem with that is you're not going to attract good customers, in the sense that the customers you're attracting probably have cash flow problems themselves. And so if you increase the credit terms, you're probably attracting bad business, in which case you're probably going to have to write off more accounts receivable in the future. So that's probably not the solution to the problem here. So to wrap up this hypothetical case, I just want to say that we really don't have enough information given the amount of financial statements we've been looking at. There's some details that are missing. What I really want to get at would be, why did the cost of sales go up so much? We could simply just attribute it to really fast growth. Really fast growth, as I said before, can cause a lot of bottlenecks in supply chain, a lot of problems in managing inventory, and even people. So it could involve a lot of overtime salaries, which would boost up the cost of goods sold and other expenses. And may even involve consultants and subcontractors. And what I'd really want to see would be, what a breakout in divisions. I would imagine that a company like this would have multiple divisions. It might have a chip division, it might have a pretzel division, it might have a power bar division, a soft drinks division. And I'd want to see how cost of goods sold and sales changed in each of those divisions, and then regionally also. So you might want to look at a matrix. So you'd have various divisions across here. In here you'd have Northeast, Southeast, Midwest, Northwest as an example, and see where things deviated in this matrix to get a better handle on what's happened to this company. Most financial statements will have such information in the form of income statements, because analysts love that type of information. They eat it up. That way they can pinpoint the specific areas that are causing the problem, and management can too.